Hello and welcome back to another video. In today's video I'm going to share with you how I managed to yield 3% trading EURUSD as a result of market participants' chosen trading actions. I'll walk you through the strategy I used, which incorporated the economic calendar, leveraging key data releases to increase probability and predictability in my trades. I'll also share how I actually incorporated my technical analysis on the dollar index and 10-year US government bonds to actually refine my decision making and make a more informed, higher probability trade. So firstly, let's actually jump into one of the foundations I actually incorporate into my trading edge, which helps me remain a consistently profitable trader. Now, the key aspect that actually helped me secure this 3% return was solely planning my execution around the economic calendar. Now, by doing so, you're actually able to capitalize on scheduled news releases, which significantly increase the probability and predictability of price movements. So, after major news events, particularly in highly liquid markets such as EURUSD, the pair we actually managed to take advantage of market participants' chosen trading actions, we often see order book tightening. This happens when institutional players actually adjust their positions. Essentially, what's happening is they narrow the spread between the buy and sell orders to actually control the movement of price and mitigate slippage. Now, this can be illustrated on our charts, such as our expansion. Now, before we actually see this expansion, we want to see some sort of range of consolidation, then our manipulation either driven from driver or our market participants' chosen trading decisions to actually set us up with a probable framework. Now, going back to the order book tightening, this actually creates a scenario where there's simply fewer resting orders to absorb price fluctuation or shift the chosen instrument's direction. This actually results in a clearer, more predictable path for price to actually follow in the direction that aligns with institutional intent. This is where you're going to get these high probability moves that you can actually take advantage of, as the institutional players are the participants that are actually moving the market. Let's get on firstly to analysing our 10-year US government bonds. So as mentioned, another critical part of my strategy actually involves the analysis on our 10-year US government bonds. These bonds are often seen as a benchmark for interest rates and a reflection of broader economic sentiment. The reason why I actually focus on them is that they have a strong correlation with the dollar index. As yields on the 10-year bonds rise, it typically signals expectations of tighter monetary policy, which strengthens the US dollar, and vice versa. By keeping an eye on our 10-year bond yields, I can actually gain an insight into potential shifts in market sentiment and overall dollar strength. Now, with saying that, it's actually important to just locate, the more simple picture, where they're actually trading on our higher time frame, and where is, the most obvious drawn liquidity. So for the week that I actually traded, it was going to be our previous yearly high, a significant level of liquidity. As you can see, market participants showed intent of higher prices, which made our draw more predictable, as we traded above our daily fair value gap and managed to actually close above our previous weekly high on Tuesday. Now, this is when you want to actually be waiting for, our news drivers to actually play out. We can see on Wednesday, this is when we had our NFP and unemployment claims, so our significant drivers, and we can actually see us, engineering liquidity just below our previous yearly high, and we can actually then see what was left behind as a result from these trading actions, which was our daily fair value gap. So this is where probability comes into play. More than likely than not, market participants are going to trade price towards our daily fair value gap and make a push price upwards. Now, I'd actually want to wait to see a reaction from our daily fair value gap and then just look to execute a trade on EURUSD, in line if it's a favourable setup towards our draw. Now, you can see how the remaining two candles of our week actually become predictable once our first three have actually materialized. And, trading this way, it drops your frequency, okay? Because there's not always going to be a probable and predictable trading day. We're saying that what it actually does do is increase your win rate because you're actually taking probable and predictable trades. It's very, very simple, but very, very effective. So, overall, I'd literally just be, looking at the wider picture. Where, as a whole, are they actually trading to, and what are the significant levels of liquidity where market participants are most likely going to purge and trade towards. Now, let's actually move on to our analysis on the dollar index and its direct impact on USD. So, the dollar index is essentially a measure of the strength of the US dollar against a basket of 6 major currencies, and the euro makes up the largest portion of that basket. Because of this, movements in the dollar index actually have a strong inverse relationship with EURUSD. To put it simply, when the dollar index rises, it typically signals that the US dollar is strengthening, which tends to put downward pressure on EURUSD, and vice versa. So, by closely actually tracking the dollar index and using, the same sort of concepts used for the 10-year US government bonds, you can actually, have a more accurate draw and actually add to the predictability and probability of, aligning your trades with another pair to overall add confluence. So let's actually dive into the week. As you can see, Monday's roll, very unpredictable. We actually had no USD drivers, as mentioned. We first actually engineered liquidity to sell side, just above our weekly fair value gap. Now, from this point onwards, going into Tuesday actually showed intent that market participants do want price higher. Now, it's not until we actually managed to close back above our daily imbalance in price to where this move to our buy side liquidity became predictable. Now, as soon as this happened, this is where you want to actually be setting up, getting ready to anticipate this move towards and actually locating the tracks market participants left behind. And in this case, it's going to be our 4-hour fair value gap. Now, swiftly moving on to EURUSD, as I've briefly talked about the importance of the two and why I use them. Let's actually focus on our execution and the pair that we actually executed on. So we can actually see on Monday we actually had our Euro news, our German prelim CPI, and this is where we actually saw some of our internal range liquidity being swept. Now from this point onwards, more likely than not, there was going to be some sort of short reversal towards this leg. Now predictability towards our low is not yet clear up until my actual execution. Now I'll get onto that a little bit more now. So Wednesday we actually had our significant news driver, NFP and unemployment claims, and this was our driver for some sort of, to actually show intent where market participants do want to trade price for us retail traders. And this can be observed as we've actually disrespected our daily fair value gap and managed to actually close below it. Now, very simply, what are, tracks left behind that we can take advantage of? Our 4-hour fair value gap. You can see our participants actually traded this up and then straight away to my draw. Now, let's actually focus on how our news driver was used to actually deliver price in a more swift, effective and double way. We can see got our unemployment rate and non-farm employment change, and this was obviously the driver towards our previous weekly low. So overall it was a good trade, and what this swing position actually did was remove our noise from trading this week, as there was actually quite a lot of uncertainty towards the start of the week where, or if market participants were either going to trade price lower the dollar index, actually towards our weekly fair value gap, which we have only seen up until now, which is the 24th of January. But yes, overall, very nice trade. Now, to wrap things up, I want to stress once again just how crucial it actually is to have a well-defined trading system in place. Now, a system that focuses on probability, predictability, and discretion is what separates consistent traders to those who are just reacting to the market. Probability and predictability come from using the right tools, like the economic calendar, the dollar index, and bond yields, to actually identify, these probability setups and where they are most likely going to present themselves and when. This gives you the framework to make a more informed decision rather than actually relying on a gut feeling or, random guess just because a fair value gap has actually presented itself at some random time in the day. But of course, discretion does play a key role as well. No two market conditions are the same, and sometimes you'll need to use your judgment to actually adapt to the current environment. A rigid system without room for discretion can be just as harmful as actually trading without any system at all. So bear that in mind. But the key takeaways for this video is that trading is not actually about being right every single time, but just about having a strategy that gives you the highest probability of success over a long period of time. So stick to the same system, trust the process, and then with consistency, you'll actually end up seeing better results in the long run. So, thank you for listening, and thank you for watching if you made it this far.